Welcome back to the channel. Today, we're diving deep into Suntec Real Estate Investment Trust, or Suntec REIT, a Singapore-listed REIT that presents a fascinating, yet complex, investment profile. If you're looking for insights into one of Singapore's major REITs, you're in the right place. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. Suntec REIT stands out with its robust operational performance in its core Singapore assets, which provides a strong foundation of high occupancy and consistent positive rental reversions. However, it's also faced significant challenges, including elevated financing costs, the impact of losing its managed investment trust status in Australia, and valuation pressures in its overseas properties. Despite these headwinds, the first quarter of 2025 showed a positive year-on-year increase in distribution per unit for the first time in several periods, signaling a potential turning point. This suggests that while there are still challenges, the REIT might be stabilizing and entering a recovery phase. Suntec REIT's primary strategy is acquiring and managing income-producing properties, mainly office and retail, to deliver stable distributions and long-term net asset value growth. As of December 31, 2024, Suntec REIT assets under management exceeded 12 billion Singapore dollars. Its portfolio is a mixed-use composition of office, retail, and convention properties. Let's look at its geographical spread. Singapore is the predominant share at 77.9% of AUM. Australia accounts for 12.4%. The United Kingdom makes up 9.7%. This strong Singapore concentration means the REIT performance is highly susceptible to Singapore's economic and real estate cycles. Its flagship asset is Suntec City, Singapore's largest integrated commercial development, and it holds significant interests in other premier Singaporean properties like One Raffles Quay and Marina Bay Financial Centre. In terms of revenue contribution as of December 2023, the office segment is the primary driver at 73.2%. Retail contributes 23.2%, and hospitality, mainly convention, makes up 3.6%. The quality of its core Singapore assets provides a defensive advantage, as tenants often gravitate towards prime, well-located properties during uncertain times. Suntec REIT's stock has shown notable underperformance compared to the broader Singapore market. Over the past 5 years, Suntec REIT declined by 30.2%, while the market gained 40.7%. Several factors have contributed to this decline, especially in FY 2024, elevated financing costs. These directly impacted distributable income and DPU, with the average financing cost for FY 2024 at 4.06% per annum. Lower distributable income in FY 2024 was also due to the completion of a capital distribution in 2023, creating a higher comparative base. Underperformance of overseas properties. Vacancies in assets like 55 Curry Street, Adelaide, and the Minster Building, London, partially offset positive performance elsewhere. Property values in Australia and the UK also saw declines in FY 2024. A particularly significant headwind was the loss of Australian Managed Investment Trust (MIT) status. This happened because 2 unit holders' holdings exceeded the 10% threshold, making Suntec REIT ineligible for concessionary withholding tax rates. Distributions from Australia are now subject to a higher withholding tax rate, increasing from 10 to 15% to 30 to 45% for FY 2025, with a pro forma impact of approximately 4.5 million Australian dollars to 8.1 million Australian dollars on FY 2024 income. This is expected to lead to a further decline in DPU in FY 2025. Despite the challenges, Suntec REIT has demonstrated significant resilience, largely driven by its Singapore portfolio. Singapore office portfolio achieved 26 consecutive quarters of positive rent reversion, with a strong 10.3% reversion for 2024 and 8% in Q1 2025. Committed occupancies for key Singapore office towers remained strong, exceeding 98% in FY 2024 and 98.7% in Q1 2025, surpassing the core CBD market occupancy. Suntec City Mall Retail showed strong performance, achieving a full-year rent reversion of 23.2% in FY 2024 and 10.4% in Q1 2025. Committed occupancy improved to 98.4% in FY 2024 and 98.2% in Q1 2025, and mall traffic grew by 6.2%. Suntec Convention segment has shown strong growth momentum, with income increasing by 16.9% in FY 2024. In Q1 2025, net property income for the convention business surged by almost 177% year-on-year, driven by an increase in smaller but high-yielding MICE events. This dramatic NPI growth suggests it could be a significant contributor to overall improvement. Management has also been proactive in debt refinancing. In 2024, 950 million Singapore dollars in loans were refinanced, saving 3.1 million Singapore dollars annually. An additional 730 million Singapore dollars of refinancing for FY 2025 and FY 2026 was completed, saving 1.8 million Singapore dollars annually. They strategically divested 58.3 million Singapore dollars of strata units at Suntec City Office Towers at a 24.5% premium to book value, using proceeds to pare down debt. This demonstrates a disciplined approach to capital allocation. Let's look at the numbers. For FY 2024, gross revenue was 463.6 million Singapore dollars, up marginally by 0.2%. NPI declined by 0.8% to 310.8 million Singapore dollars. Total distributable income was 180.9 million Singapore dollars, a 12.5% decrease, leading to a DPU of 6.192 cents, down 2.3%. However, Q1 2025 showed signs of stabilization and improvement. Gross revenue increased by 3.4% year-on-year to 113.5 million Singapore dollars. NPI saw a healthy 5% increase to 77.1 million Singapore dollars. Critically, distributable income increased by 4.3% to 45.9 million Singapore dollars, and DPU improved by 3.4% year-on-year to 1.563 cents. This marks the first positive year-on-year DPU growth since the first half of 2022, attributed primarily to better operating performance from Singapore properties and lower financing costs. Overall portfolio occupancy stood at a healthy 95.1%. Singapore office occupancy was 98.7% and Singapore retail was 98.2% in Q1 2025, demonstrating remarkable stability. Suntec REIT's debt profile is a crucial aspect of its financial health. As of March 31, 2025, total debt outstanding was 4,361 million Singapore dollars. The aggregate leverage ratio was 43.4%. While this is considered higher than the sector average, it remains within the Monetary Authority of Singapore's regulatory limit of 50%. The interest coverage ratio was 1.9x as of March 2025. This is above the regulatory limit of 1.5x, but below the 2.5x benchmark often considered healthy for REITs, indicating a relatively tighter buffer. This higher ALR and tighter ICR imply greater sensitivity to interest rate fluctuations. A 10 basis point change in financing cost can impact DPU by approximately 0.186 cents. Around 65% of the debt was fixed or hedged as of March 2025. The weighted average debt maturity was 3.24 years. Looking ahead, while interest rates are expected to ease gradually, Suntec REIT's all-in financing cost is likely to increase by 10 to 20 basis points. This is because interest rate hedges expiring this year were secured at significantly lower rates. This catch-up effect means DPU will face continued pressure from financing costs in the near term. Growth forecasts present an interesting picture. Revenue is forecast to decline by 1% per annum over the next 3 years. However, annual earnings are expected to grow significantly at 13.8% per year, which is faster than the Singapore market's forecast of 6.9%. This divergence suggests a focus on efficiency and bottom-line management rather than aggressive top-line expansion. Singapore market trends remain supportive. The office sector shows renewed vigor, with core central business district Grade A office rents rising. Limited new office supply from 2025 to 2027 is expected to support rental stability. The retail sector also shows resilience, driven by tourism recovery, with positive rental reversion anticipated. Suntec REIT expects its Singapore retail portfolio to maintain high occupancy and positive rent reversion in the range of 10 to 15%. However, key risks remain: persistent macroeconomic uncertainty, the lagged impact of interest rate hedges expiring at lower rates, which will likely increase financing costs, ongoing underperformance and valuation pressures in the Australian and UK portfolios, the loss of Australian MIT status causing higher withholding taxes, potential structural changes in office demand due to work-from-home trends. Increased retail supply in Singapore from 2028 could introduce competitive pressure. Foreign exchange fluctuations, particularly a strong Singapore dollar, can reduce translated income from overseas properties. Suntec REIT offers a nuanced investment case. Its strong, resilient domestic portfolio in Singapore is acting as its primary performance anchor. The positive year-on-year DPU growth in Q1 2025 suggests a potential turning point, supported by proactive debt management. So, is it suitable for your portfolio? Suntec REIT could be a suitable consideration for a diversified portfolio if you're seeking exposure to a fundamentally sound, Singapore-centric REIT with a management team demonstrated to navigate challenging conditions. It offers a relatively stable income stream from its prime Singapore assets and a recovering convention business. It is particularly suited for investors with a medium to long-term investment horizon, as the benefits of interest rate easing and full recovery of overseas markets may take time. You should have a tolerance for moderate leverage, given its higher gearing ratio and tighter interest coverage ratio. And finally, a belief in the continued strength of the Singapore commercial property market is essential, as the REIT performance is heavily reliant on this segment. It may not be ideal for investors seeking aggressive short-term capital appreciation or those highly risk-averse to leverage and international market volatility. A balanced perspective, acknowledging both its core strengths and existing headwinds, is essential for informed portfolio allocation. That's our comprehensive look at Suntec REIT. If you found this helpful, please like this video, subscribe to the channel, and let us know your thoughts in the comments below. See you next time.